A lot of people get confused about whether they should be doing Roth accounts or traditional accounts, whether this is your company 401k or your individual IRA account. What should I be doing? What even is Roth and what is traditional and what makes sense for me? In today's video, I'm going to break down the differences and the benefits between the two so you can decide. I'm Matt Sorensen. Let's build wealth. All right, I want to break down traditional Roth, but also compare it to investing money outside of a retirement account. And let's just take a regular brokerage account. And this could be something you're investing in stocks or mutual funds or even crypto with. It doesn't matter. But I'll go over how these accounts work and show you the benefits of using traditional or Roth accounts, and then even, of course, compare traditional to Roth. Let's say you decide to just put it into a brokerage account to go buy stocks. I put that $5K in. Do I get a tax deduction? No. There's no tax deduction or tax incentive to put money into a brokerage account. As I'm investing that money and it grows, I've made some money on that. Do I pay tax on that? Yes, you do. No tax-free growth in a brokerage account. You're getting dividends or you sell stock or whatever's in the account for a gain. You're going to pay taxes on the gain. It's going to go on your tax return. And when I pull the money back out, do I pay taxes on it? Well, not really. Only the gains or appreciation you've had in the asset. If you put $5,000 in and it's gone up to $6 and you sell and take the whole $6 out, well, you only have $1,000 of gain. So the money you put in is not getting taxed on the way out. So that is a benefit there. I've already paid tax on that money in the brokerage account, so no tax on principal on the way out. But any growth or any appreciation, I'm going to have taxable gains on that. All right, now let's look at the traditional IRA. The difference here is huge, and that is if I put $5,000 in a traditional 401k or a traditional IRA, I get a $5,000 tax deduction that goes on my tax return that reduces my taxable income, which means I'm going to pay less tax to the federal government and to your state. Also, as that money is investing and growing, you sell the stock for a profit, you have gains. You could be buying crypto in your IRA or 401k, by the way. That's what we do at Directed IRA. You could be buying real estate, private equity, LLC, small business. It doesn't have to be stock. I'm just giving that as the baseline example here because most people understand that. But again, let's say that this went up to $6,000 in value in the retirement account. You don't pay tax on it. Nothing's hitting your 1040 or your tax return here. So no tax on the growth. We like that. Now, when you pull money out of a traditional IRA, the downside is once you hit retirement plan age of 59 and a half, there is tax on the way out. Don't love that. But I'm 60. Maybe I'm in a lower tax bracket than I was when I was earning that money. I'm pulling it out in smaller amounts to live off of. Hopefully there's a lower tax burden there. That's kind of the mentality of people that love traditional accounts, is they're planning to be in a lower tax bracket at retirement. They got the benefit of a tax deduction as they put the money in. They had no tax on the growth, so every penny of profits that they had, you're got to be reinvested. They never had to pay any tax on it. And the value of that over a 20, 30-year period of investing is huge because every dollar gets to be reinvested to go buy more assets and grow more benefit and hopefully have a larger account for you when you hit retirement. All right, now let's look at the Roth IRA or Roth 401k. This is where I'm at. I prefer to do Roth accounts. I moved all of my accounts to Roth. I had traditional accounts before. I've converted all of them to Roth, but I'm now even contributing only to Roth accounts. Now, the downside to a Roth account, no tax deduction when I put the money in. You threw $5,000 in this year. The IRS is like, good for you. You get a pat on the back, but no tax deduction. It doesn't save me taxes today. Remember, the traditional account is the only one that gives you a tax deduction or incentive today to put money in. The Roth, I don't get it. But the next two reasons are why I like the Roth. As I'm investing that money and growing it, there's no tax on the growth. Again, just like the traditional, every penny of investment returns gets to be reinvested. It's not going on my 1040. I'm not paying any taxes to the state or IRS. Everything gets to be reinvested, which is huge. Again, looking at a 20, 30-year period of investments and growth. But the last reason here is why I love the Roth IRA and Roth 401k. As you pull the money out at retirement, 59 and a half, there is no tax on the way out. No tax on the gains, no tax on the money you put into it. Zero tax to you on the way out is the only way to make money growing and investing it in the US and be guaranteed that you will pay zero tax. It's a strategy staring us right in the eye, the Roth IRA and Roth 401k, and you can use it to pay no tax. So that's why I love it. I didn't get a tax deduction to put the money in, but I'm playing the long game here. We're getting growth as we're investing in the account and we're paying zero tax on the way out. Now, since I love the Roth account, I just want to go over a couple other benefits to it and go over a couple of misconceptions people have about it. First of all, the Roth account, the contributions you put in to a Roth IRA in particular, you can put $7,000 in a year. You can take out those contributions whenever you want. So if I had 10 years of Roth contributions of $7,000, 70 grand, and my account's now worth $150,000, I can pull out the 70,000 of contributions at 40, at 45, at 50. You don't have to wait till you're 59 and a half to pull out the contributions that you pull in. Only the growth is what you have to wait to get out till you're 59 and a half. So that's a huge perk to a Roth account. I can pull the money out that I put in whenever I want. The next benefit to the Roth account, you can say this for traditional traditionals as well, you can file bankruptcy and keep your Roth or traditional IRA or even your 401k. So it's a great place to save and build wealth because it's protected from creditors. Now, my final comment here, and this is about the Roth. I hear a common complaint of people saying, Matt, I make too much income. I can't contribute to a Roth IRA. And there is a rule on this from the IRS that says if you make over a certain amount of income, 160K single, 200K plus married, you can't make a Roth IRA contribution directly into the Roth IRA. But you can do something called a backdoor Roth IRA. It's what I do. A lot of our successful clients do, which is you put in the annual contribution, $7,000. If you're 50 or older, it's $8,000. It's a non-deductible contribution. You don't take a deduction, and you do that on your tax return, and then you convert it to Roth. It's the same thing. It's what's called the backdoor Roth IRA. You can do it at our company, Directed IRA, at Fidelity. Any sophisticated financial advisor knows this strategy. So don't take the Roth IRA off the table if you've heard high-income people can't do Roth IRAs. That's not true. They just have to do backdoor Roth IRAs. Now, you can have both, actually. You don't have to pick one or the other. You might have a 401k at work where you put money in and you take a deduction. You do traditional contributions there. And the company you work for may match it with traditional dollars too. So you might end up having traditional 401k dollars, but then you do a Roth IRA outside of the company 401k because you want to grow some tax-free dollars where this money is going to grow and come out tax-free at retirement. The traditional account is what I call tax deferred. It's not tax-free because I'm going to pay taxes later when I come out of retirement. But again, if you're chasing tax deductions now, I'm trying to lower my tax bill right now. And a lot of end of year planning for our clients is we're doing traditional accounts because they're trying to save money on their taxes today. So there's different mentalities to this. There's different reasons to do one or the other. It depends on whether you're worrying about taxes now or having tax-free growth and tax-free distributions later. Now, the long haul approach, in my opinion, is the Roth wins out. Who knows what type of taxes we're going to have when we hit retirement? I'm 44. I'm expecting taxes to be higher by the time I hit retirement. Who knows where we're going to land? But the nice thing about the Roth account is I know that account is going to come out totally tax-free at retirement. I could turn a $10,000 account into $1 million account, and that $1 million is coming out tax-free in retirement. Now, IRAs and 401ks, Roth versus traditional, this is just one thing that you need to learn to grow and build wealth. Please make sure you're subscribed to my channel. I'm giving you tips on saving taxes, protecting your assets, building and growing wealth. I'm Matt Sorensen. We'll see you next time.